A lot of people like to take your stance and then Bill Gross's stance. You took opposite positions on Treasuries this spring. You were very bullish on them. Bill Gross was getting out of them. What's your position now when you've got a 2-year, 2% handle on the 10-year? How are you making money on that?
Yeah, I mean, I think our longer-term perspective is rates aren't going dramatically higher anytime soon. There's so many reasons to keep rates low, demographics. There's not going to be nearly the amount of fixed income production you saw in prior years. That being said, the 2 years at 20 basis points, the 10 years at 2-ish%, a little over 2% now. My sense is rates are going to gradually rise. They have to rise from these levels. But we're not moving up dramatically. The fixed income is still a desired asset class. But, we think you could see some rate rise from these incredibly low levels.
And for you, you're obviously playing both sides. You're buying, you're selling. Prices are up on Treasuries, yields are down. How does that play out for you? Which are you looking at more? Are you focusing solely on yields?
Yeah, I mean, one of the things that's the most important thing today, if you believe in this dynamic that we're going to be in a low-growth, low-yielding environment for a long time, which I think is right, and we're looking for ways, how do you create income? And how do investors get yield and how to get income? The dividend yields in the equity market get it. Well, where do you get it in fixed income? There's asset classes like high yield, asset classes like asset-backed securities that get you some yield. That's where we're trying to get today. In a low-rate environment, how do you get income for investors?
One thing that stood out to me, you said recently, in 25 years of doing this, you've never seen the corporate sector in such profoundly good shape, even with the struggling economy.
Yeah.
We haven't. It's this oddly fascinating dynamic that could persist for a long time. How does that impact how you're managing money?
It's arguably the most important thing, not just in terms of how we manage money, but for the economy. I mean, literally in 25 years, 40 years, companies have never been in better shape in terms of the cash position, their ability to generate free cash flow. So what it means is you can actually have, while the economy may be slow, maybe even dip in a recession, that companies are in great shape. In prior down cycles, companies would struggle. So we'd love to look at credit assets. We're looking at credit assets of both investment grade and high yield. Really different dynamic. It's also, you think about what you can stimulate growth in the economy today. It's the fact that companies are sitting on so much cash. If they get more confidence, then you start to get CapEx growth, hiring growth.
I just wonder how long you think it's sustainable, because the way that I see it playing out more and more is that the weaker the U.S. consumer gets, the less confident the U.S. consumer gets. These companies cannot sustain themselves on relying on emerging economies to buy their goods.
I totally agree with that. The only thing I would say is it all is intertwined, that if there is a sense of confidence that comes back, and it has a lot to do with policy around the world, and if you have a sense that there's stability in policy and Europe is stable, companies will spend more money. Because they're sitting on so much cash today, they'll grow CapEx, they'll grow hiring. By the way, if they grow hiring, it means employment's going to obviously picks up, and it means income picks up and consumption picks up.
But do you see any sign they're going to grow hiring?
Not today. I mean, today it's going to be, I think there's structural reasons why unemployment's going to be there for a long time. It means the Fed's not going to move for a very long time. And so I think that's hard. I do think, though, that it can't happen organically, but it has to happen if companies see growth and, some growth in the emerging world. The emerging world is moderating for sure, but it's not going into recession. It's still decent growth. I could see an environment where we run at 1% to 2% growth for a while. Well, if that's right, and you will see some hiring, but I agree with you, structural unemployment will be there for a long time.